we are going to discuss about what is a stock index. So whenever when you open the news channel or newspaper, you would hear the words called stock index down by 2%, stock index up by 10%, like that. So these are the common buzz terms that you hear whenever you open a newspaper or news channel. So before going to that, we will try to discuss the general information about the index. So generally index is used to measure a change. For example, CPI, Consumer Price Index, so which measures the inflation rate of a country. So similarly, temperature, if suppose the temperature in Chennai was 33 degrees Celsius last day, means if suppose the temperature today is 35 degrees, the change in temperature is 2%. So which is also another index for measuring the temperature. Similarly, there are n number of indices in the real time for measuring the change of a particular thing. Similarly, in stock market we have n number of indices to measure the change of the value. So nearly 7,000 companies listed on BSE and NSE. So it's very tedious job to measure the stock value every day of each stock to determine the stock market trend of that country. So for that, what they are trying to do is they are trying to group similar stocks and try to find the index value. For example, if suppose if there are n number of stocks of a bank company, for example HDFC, ICICI Bank, and then Lakshmi Vilas Bank, like that, they will try to group those stocks and they will try to find the index value. Then that would be determined as bank index value. For NSE, there would be some separate code for the bank index value. For BSE, there would be separate index value for bank index. And then the another way of grouping those stocks is market capital. So the stocks that companies whose market capital is if suppose if if suppose if there is a company called X and the market capital is 10,000 rupees, if there is another company called Y and the market capital is 10,000 rupees, then these two companies would be treated and they are grouped and they would be find the index value for that company. And this is another approach. Another approach is share price. They will try to group these stocks whose share price is very similar. For example, X company's share price is 100 rupees and Y company's share price is 100 rupees. They will try to group those shares and they will try to find the index value. So by following this procedure, they will try to find the index of a particular sector, a particular market capital company. So the resultant would be for NSE, there are n number of indices like NSE 100, NSE 50, like that. For bank sectors, there would be a bank sector index, like that. We need to use this formula. They are using this formula to find the index value of a index value. So free float market capital of grouped stocks by base market capital. So free float market capital of a group stocks equal to stocks which are publicly available for trade. So there would be 10,000 stocks when IPO was done, but there would be only 500 stocks that would be publicly available for trade. That would be considered for calculating the free float market capital. We will try to cover those inner details in detailed manner in the upcoming videos. For now, just consider this the formula: free float market capital of group stock by base market capital into base index value to calculate the index value of a particular thing. So thanks for watching this video. If you want to open an account in Zerodha, you can use my referral link that would be present in the description box of this video.